All right, my friends, welcome back to the Wealth Outside of Wall Street YouTube channel. You are in for a treat today because today, not only are we going to be talking about getting your money off of Wall Street and becoming financially free, I'm going to give you the most powerful and dynamic financial instrument ever invented by mankind. That is right, my friends, ever invented by mankind, coming to you on this YouTube channel. Now, I don't mean to make light of this because this is one of the most dynamic tools that will ever come across your YouTube channel if it's done right. So this is part 3 of a 4-part video series, meaning if you have not watched video number 1 or video number 2, as much as I hate to say it, pause this one and go back in time and watch those previous 2 videos. But today, my friends, I'm going to do something that I don't normally do. I'm going to invite you to come into my world, look at my screen, and I'm going to map out exactly how the infinite banking policy works. Some things in life are better seen than they are heard. So today you're going to hear me, you're going to see me, and we're going to go right after this. So come on over, let's look at my computer screen here and let's get after it. Okay, you are here learning about the passive income machine and more specifically about the infinite banking concept. Now, something that's critically important that most people fail to understand is the infinite banking strategy is only as good as the strategy that it's used within. By itself, infinite banking is rarely the answer to your financial situation. So inside of the passive income machine, this sits at the central part of everything we do inside of creating financial freedom in 10 years or less. Now, we happen to call these unique type of strategies and these unique type of policies, we call them the vault. And the vault is a critical component of building wealth. So let's dive right into this and let me give you a little bit of perspective on how most people handle their money as it relates to trying to plan for the present as well as the future. Most people, when it comes to short-term investing, they take their money and they put it in a bank. Well, why do they do that? They want to keep their money liquid and safe. They want to make sure that if they're saving for their family trip to Disneyland, that the money is still there. But in order to keep their money in a bank, they know they're going to be earning a very, very small return on investment. Now, they're willing to do that because they value the liquidity and safety. Now, once people start thinking more about the long run, they start to shift their perspective. And rather than using a bank, what do they do for the long run? Well, most people are taught that they need to put their money in the stock market, whether it's through a 401k, a mutual fund, or a brokerage account. They're putting their money somewhere, and the hope is they're going to get a higher return on investment than they would in a bank. Now, the downside of putting your money in the market or anything else for the long term is it's not liquid. You're not going to use your money to fund your vacation that's sitting in your 401k, and you're open to likely taking more risk. To get a hopeful higher rate of return, you have to be willing to take more risk to get it. Now, if you notice this, there is a trade-off. There is a downside with both scenarios. In the short run, you're willing to get the liquidity and safety and take a smaller ROI. In the short run, you're willing to take a smaller ROI, but in the long run, in the pursuit of getting a higher ROI, you're taking on more risk and you're taking on less liquidity. Now, my friends, here's what I'm going to introduce you to. The infinite banking concept, the vault, will ultimately produce financial freedom because it's going to overcome the downsides of both short-term and long-term investing for most people. Here's what you're going to get. When your money is in one of these accounts, your money is going to be earning a high tax-free return on investment. Your money is going to be 100% safe. Your money is going to be 100% liquid. And then the biggest advantage of this, you now enter the world of becoming a bank, using and accessing leverage. Now, I want you to understand what leverage is. Leverage is a force multiplier. It's measured by the difference between inputs and outputs in the system. Meaning, if you have $1 and you put it into a system and it only does the job of $1, meaning it earns a rate of return in a 401k, you have no leverage in a system. But if you have $1 and you put it into a system and that dollar now can subsequently start doing multiple jobs, then guess what, my friends? You have leverage in a system. Now, I want you to consider this. The only difference between the wealthy, I believe, and almost everyone else is the fact that they understand leverage and they utilize it more frequently and more effectively than most people. So if you want to become wealthy, financially free in 10 years or less, leverage, my friends, is the key to doing this. Now, you already believe in the power of leverage. Let me prove it to you. If you went out and bought a house, right, I'm going to use really easy numbers here. If you went out and bought a house for $100,000, okay, and you bought this house right here for $100,000, and let's say over the next 12 months, it appreciates, right? The value of the house goes up by $5,000. Forget the fact that it has, cash flow or anything like that. If it goes up by $5,000, what is your rate of return? Well, it's 5%, right? You bought it for $100,000, it went up by $5,000, your rate of return is 5%. But if you bought the same house and you used leverage, right? All you did is put a 20% down payment or $20,000, it would still go up by $5,000. It's still going to appreciate, but by using leverage, your rate of return went from 5% to 25%. Do you see how massive of a difference that is? Now, my friends, I'm going to introduce you to the vault, and this is going to radically revolutionize the way you see money. So make sure you're in a place where you can pay absolute attention to what I'm about to share with you. The vault is an overfunded, cash value focused whole life insurance policy. That's right. Now, once your money's in a vault, you're going to get several things. The main thing we're going to focus on is the access to your, is the ability to use leverage inside of your money. But this is what's going to happen once your money's in this account. And it's important to understand the multifaceted benefits that the vault provides. Number one, it's going to give you a guaranteed return. Number two, it's going to give you an annual dividend, meaning your money is compounding and growing every single year. Number three, it is 100% safe. Your money is not correlated with the stock market. It doesn't matter if it's going up or down. It's a private contract between you, a private individual, and a private insurance company, and you are 100% protected, backed by a private contract, guaranteeing you the growth and the accessibility of your capital. Now, one of the main reasons that we'll talk about in video number 4 of this sequence is the fact that it's tax-free. The greatest destroyer of your wealth, my friends, is taxes, and with a vault, we get to eliminate and kick out the IRS out of our future growth of our capital. It will give you a future stream of income whenever you want it, 100% tax-free, because it still is life insurance. It's going to protect the most important asset, which is you, but this is the main thing we're going to focus on, my friends. You now step into a world where you have an immediately liquid and open line of credit. Okay, so the vault, when created appropriately, is the foundation of the infinite banking concept. Your policy functions as a bank account with very special privileges. Now let me walk you through how most people think of insurance and why most insurance are not infinite banking policies, okay? Most people, when they go to buy insurance, they do what Dave Ramsey tells them. They buy term and they invest the difference. Now, that's why most people are broke, but life insurance inherently is not a bad thing. When you go to an insurance company, this is the way you do it. You want to get the maximum amount of life insurance, whether it's a term policy or a whole life policy or anything else. You want to get the exact amount of insurance you need or want, but because the only way you win in that equation is if you die, right? You want to pay the least amount of money for it. This is why most people say buy term and invest the difference. And my friends, you should have life insurance, especially if you have a family. But I want you to imagine this scenario. When we go buy life insurance, we do it the exact opposite way. We want to overfund it, which means we're going to go to an insurance company and we're going to say, look, let me pay the most money I can, the maximum premium that I'm allowed to pay, but give me the least amount of life insurance. The highest premium, lowest death benefit. The most money I can pay for the least amount of life insurance. Now, if you think about this, most people would be like, why would you do that? Why would I give the insurance company more money than they're ultimately asking for? Well, here's why. All of the extra premiums that we're sending to the insurance company are now popping into a very uniquely structured life insurance policy in the form of cash value. Now, remember all of the benefits that I told you that your cash value gets. It's private, it's guaranteed, it's got a guaranteed rate of return, an annual dividend, and it's an open, accessible line of credit. This cash value now functions as your line of credit, and you can now start operating a banking style system. Now remember, in video number 2, I walked you through the 3 rules of banking. You have to follow the exact same 3 rules. Step number one, you're gonna capitalize your bank, meaning you're going to put in the highest premium that you can afford to put in. Now think about it this way. Your capitalization functions as your savings goal. If you're currently saving money in a 401k, if you're currently saving money in a brokerage account, if you're currently saving money probably just about anywhere else, you should pause, and ask yourself, is that money that's going somewhere else giving me the outcome that I want? Is it giving me the predictability, the confidence, the certainty, and ultimately is it going to help me achieve financial freedom in 10 years or less? If not, you likely should redirect your capital to an overfunded, high cash value life insurance policy. This is how you capitalize it, my friends. Now, your capitalization does 2 things for you. Number 1, it's building up all of that cash value. This becomes your open line of credit. And number 2, it's establishing a contractual guarantee with an insurance company that will allow you to use their money, now that's very important, their money to take policy loans. So, for example, if I want to go out and buy a car And the only reason I'm going to use a car is this is the most commonly referred to example with infinite banking. I'm going to use this because you understand how this type of transaction works, but at the end of this video, you're going to see why this is why most people fail with infinite banking. So before we get to the why they fail, here's how the policy loan works. If I want to go out and buy a car, and let's say that this car is going to cost me $50,000, the beautiful part of this is I now get to access leverage. I get to borrow money, not from my policy, but from the insurance company. The insurance company will loan me the money in a private loan. The line of credit is if I have $50,000 of cash value inside of my policy, I can now take a policy loan for $50,000 to buy this car. The loan will come from the insurance company, and they're going to use my death benefit as collateral. Why? Because they already know that they owe me money. If I die tomorrow with a $50,000 policy loan outstanding, they're going to pay out the death benefit minus the outstanding policy loan. Now, my friends, I'm going to share with you what the interest rate arbitrage is. And once you see this, this is why you're going to want to velocitize, meaning move your money as fast and as often as you can, just like a bank does. Now, to give you a little bit of context, I'm going to share briefly a couple of illustrations. Now, these come directly from insurance companies that we work with, and I'm going to give you more detail on these in the following video. But for now, I want you to see how fast you can build up cash value. And once you see this, if you have a policy that you think is infinite banking, this is likely why you don't have that type of policy. In year one, let's say we've got a male age 40, okay, male age 40, and he puts in $100,000 right up front. This would be the maximum amount that he wants to put in. This would be his savings goal. Now, here's the crazy part. Here's the cash value. In year one, he puts in $100,000. His cash would be $92,000, an open line of credit. Now, his death benefit, if he died tomorrow, would be $2.3 million, and you'll learn more about how this is set up in video number 4, but this line of credit right here, this cash value represents his line of credit. Now in year 2, he just switches where he was saving money. It was previously $20,000 elsewhere. Now he's putting it in a uniquely funded whole life insurance policy, and in year 2, when he puts in $20,000, his cash goes from $92,000 to $109,000. It's easy to see what his cost of insurance is, the difference between what he puts in and what he gets out. But by year 3, I want you to consider this. He is over the cost of insurance in that year, meaning he puts in $20,000 and his cash goes from $109,000 to $131,000. It goes up by $21,000. For the rest of his life, as he continues to put money into this policy, whether it's $20,000, whether it's $15,000, whether it's $5,000, his cash value builds up. Now, my friends, consider this. It's guaranteed, it's compounding, it's growing, and this becomes an open line of credit. Now, here's a similar example, but not front loading it. In this example, this is a female age 40. She puts in $40,000. That $40,000 immediately nets her $31,000 in cash value that she can use as a line of credit, and it nets her a death benefit of $899. Now, the death benefit is used as collateral, but now she can borrow $31,000 from the insurance company. In year 2, when she puts in $40,000, her cash goes from $31,000 to $66,000. So most of what she puts into the policy shows up in cash value, but in year 3, she's over the cost of insurance in that year. She puts in $40,000 and her cash goes up by $40,000. My friends, and as this goes on, as she continues to put more and more and more money in, you can see her cash value just compounds and continues to grow. Now, 25 years out, if she followed this example out that I put in front of you, and I'm not going to spend too much time on this, she would have put in $475,000 of her own money, but her line of credit would have grown to $1.1 million. And she has the opportunity to use this money all over this 25-year period of time without ever breaking the compound interest. Now I'm going to skip the rest of this and I'm going to get right to the math here. So let's get in to how the infinite banking concept works, okay? Again, we're going to use a car loan. We're going to borrow $50,000 to buy this car. Okay, money is going to come from the insurance company. That would mean we have to have $50,000 of cash value already sitting inside of our policy. But here's how this is going to work. Now, one of the things that the book Nelson Nash, Becoming Your Own Banker, talks about is when you take on this mantle of putting money into a policy and leveraging it, you become a banker. And I want you to consider this. When you are a banker, imagine yourself as owning a bank. If a borrower came into the bank, your job as the banker would be to lend that money to the borrower with the highest probability of getting that loan repaid so you generate profit for the bank, right? The bank wants profits. Now the borrower walks into the bank and just wants money, right? And if the bank never asked for, hey, don't worry about it, you don't have to pay the loan back. If the bank never asked for or set up loan provisions, right, the borrower would never pay the loan back and the bank would never be profitable. So my friends, here's the key. When you set up a policy, you are both the banker as well as the borrower, meaning you have competing interests. Of course you want cash now, but the only way that this system is successful is if you act as a responsible banker. So ultimately what this means is when you take a policy loan from the insurance company, you need to have a plan to pay it back. Now here's the key about this. The insurance company, because this is a private loan, they will never ask you when you're paying it back, how you're going to pay it back. You don't have to set up repayment terms. You don't have to make minimum monthly payments. And it does not affect your debt to income ratio. It is a private loan between you, a private individual, and a private insurance company. But let's assume, my friends, if you're watching this channel, you have a high financial IQ and you know and understand that you need to have the personal responsibility to pay this loan back. So let's walk through the math of how a policy loan actually works. Okay, it's a simple interest loan, okay? A simple interest loan. And what this means is it works just like a mortgage. So as you decide to pay this back, let's assume just for this example that you decide to make monthly payments for 5 years. You're gonna pay this policy loan off over 5 years. Even though the insurance company is not asking you to make monthly payments, if you chose to do that, your payment would need to be $943.56. Every time you make a payment, here's what's happening. A little bit of that payment is going to principal. It's actually buying down or paying down the loan. The loan balance in this example from payment number 1 to payment number 2 goes down from $50,000 to $49,000. But of that $943, $208 is charged as interest. It's a cost. It's going back to the insurance company, right? That cost is going to an insurance company for the privilege of lending you money. Now, I'm going to get to the benefit of this here in just a minute, but as you see, every time you make a payment, a little bit more of your payment goes to principal, a little bit less goes to interest, and the loan balance goes down and down and down. Now, again, you're in charge of this 100%. What that means, you might make a couple of payments, and then you might skip for 3 months or 6 months or 2 years. And then after that, let's say you get back on the right track again, and you start making payments. But again, let's say your first payment is $50, then you pay a $2,000, then $1,800. You pay this off however and whenever you want. The faster you pay it off, the smaller your interest rate cost is. But at the end of this, assuming you paid it off over 60 payments over 5 years, your cost would be $6,600. Okay, so now here's what's actually happening. You borrowed money from the insurance company, the $50,000. They charge you an interest rate, and most insurance companies today that we're working with are charging anywhere between 4 to maybe 6%. Okay, so they're charging you an interest rate. That, in this example, cost you $6,600. And what you can see here is this graph that's going down, it's a simple interest rate graph, meaning every time you make a payment, more of your payment is going to paying down the principal and less is going to interest, reducing your cost. But here's the magic, my friend. That same $50,000 that was inside of your policy as the cash value, this open line of credit, that never really came out of your policy, right? You borrowed $50,000 from the insurance company, which means that over that same 5-year period of time, the money inside of your vault was compounding and growing. Now the difference here, the magic here, is it's growing at the exact same interest rate that you're paying. So if you're paying 5%, that means it's growing at 5%. Now most people on the surface would say, that doesn't make any sense. That should be a wash. I'm earning 5, I'm paying 5. But here's the magic, my friends. You're paying a simple interest rate on your policy loan, but you're earning a compound interest rate. So let me show you how that works. 5% on $50,000, well in year 1, that's gonna net you about $2,500. That $2,500 now rolls into your contract, it becomes cash value, it increases your line of credit, and it becomes part of your contract, meaning you will never lose it. It's part of your contract and it will also start compounding and growing. So in year 2, now you earn a 5% interest rate on $52,000, meaning you earn a little bit more interest. And over the next 5 years, as you're slowly paying off the policy loan, your policy is also compounding and growing year over year over year. And at the end of this 5-year example here, you would have earned $13,814. Now, my friends, here's the magic. You paid a 5% interest, you earned a 5% interest rate, but the difference is the difference between compound and simple interest. You earned $13,000, it cost you $6,600, and my friends, if you're good at math, you realize that the arbitrage on this was $7,200. You have the opportunity now to build wealth, achieve long-term goals, and leverage your capital today. Now, I want you to consider this. Now, as we start talking about how banks work, I want you to consider this. You already finance everything you buy. Imagine this, right? Walk into any bank in the world today, and if you watch video number 2, you realize all banks have cameras, and what? They all have suckers too. But in addition to that, they all have banners saying, hey, you should put your money in one of our accounts and you're gonna earn an interest rate. But right next to that banner, it says, hey, you should borrow money from us and this is the low cost of borrowing. So let me walk you through this. All money that's running through a bank means you're already financing everything you buy. So let's use this same example of a car. Without infinite banking, you only have 2 options to buy this car. Okay, you could use cash, meaning, what are you gonna do? Well, you're going to save up. If it's $50,000, every quarter, every time you get paid, you're gonna save up your money until you have $50,000 cash. Now, where's that money gonna go? Well, it's gonna go to a bank. It's gonna sit there, it's gonna wait, it's gonna be liquid, it's gonna be safe, because you're hoping that as soon as you have the $50,000, you're gonna come buy this bad boy car right here. Now, once you have the $50,000, what are you gonna do? You're gonna spend the money. You're gonna take it out of the bank, you're gonna go down to the car dealership, and you're gonna buy the car. Meaning you draw your balance down and you're back down to $0. Now, what happens with cars? The average American today owns a car for 3 to 5 years, which means you know that in 3 to 5 years, you need to be ready to buy another car. Now, you might get a little bit of trade-in value, but at the end of the day, you're gonna have to start saving for your very next car purchase. Right? So again, you build up your capital inside of a bank, you get ready to buy your car 3 to 5 years from now, you draw it out, and you're back down to $0. And this is how most transactions go inside of someone who's using cash. They build up, they spend down. They build up, they spend down. Now, if you don't have the discipline to use cash, what do you ultimately do? Your other option is debt, right? You're just gonna go to the car dealership and say, hey, I want that car right there, but I don't have any cash. So the car dealership's gonna lend you money, and then you're gonna spend the next amount of time paying off that car loan that you just took out. But once it's paid off, what happens? Well, the debt has gone down to $0, but again, you need another car. So you go back to the car dealership, you take out another loan, and you go through this process all over again. Now, the downside of using cash is what? Well, it's opportunity cost. That cash could have done something else for you. It could have earned a better rate of return. The downside of using debt, what is that? Well, you're paying a bank an interest rate. But in both cases, my friends, you are financing everything you buy. Now, why is this important? Well, again, let's go back to how this system works. You now have the opportunity to build a banking system. Now, the secret to long-term wealth is literally compound interest. If I were to draw a compound interest curve right here on my computer screen and you look at it, it's exciting, right? It's really nice, but it's not really exciting until it hits this inflection point and it starts compounding and really going up. So if I were to break this line down into 2 parts, there's an A side of the graph and there's a B side of the graph. Which side of the graph do we want to be on? Right? We want to experience this side of the graph. We want all of the big returns that are possible here. But the only way this happens is time. Your money has to grow long enough, compound long enough to get the benefits of compound interest. And this is why most people never earn compound interest. Let me walk you through what happens. There are 2 things that happen to most people's compound interest curve. But number 1, what happens? Well, they spend their money. Right? So let's say they put their money in an account and let's say it's growing, it's starting to compound, things are starting to get a little bit of exciting, but after a couple of years, something comes up. Maybe they're gonna move and they need to access money to put a down payment on a new house. They go to their account, wherever it's at, they take their money and they say, boom, I'm gonna pull it out of my account, I'm gonna break compounding interest, I'm gonna spend my money, and then if they never break compounding interest ever again, what happens? The graph has to restart. The process has to start all over again. And there's always an opportunity cost between what they could have had and what they inevitably end up with, right? So the opportunity cost is they spent their money. Now, if they never spend their money again, let's say they put their money in an account where they're hoping to get a little bit higher rate of return, so they start compounding, the market's doing awesome, and then what happens? Well, the market takes a downturn. This happens all the time in the market. So when the market takes a downturn, right, maybe it's gonna rebound, but look what happens. as soon as the market takes a downturn, it breaks the compounding interest curve again. And the opportunity cost is what could have been versus what ultimately is. So my friends, inside of this reality, you either spend your money or you lose your money, but you're constantly breaking compound interest. This is why very few people earn compound interest, and it's why only the 3%, the people who understand how to harness time and use it to their advantage, that's why they ultimately win. So let me give you the same example with a policy loan. Okay, so when you're taking policy loans, what if you buy a piece of real estate? What if you fund your family vacations? What if you buy some cars? Whatever you think it is, let's go through this process. You're gonna take a policy loan, but you don't actually break compound interest. You're borrowing money from the insurance company, your money continues to grow, you're paying back the loan just as if you were saving up for the very next purchase, just like I walked you through, but ultimately what happens, you don't break the loan. But ultimately what happens, you don't break compound interest. So a couple years from now, once you've got the policy loan paid off, you take another policy loan, you pay it back, then you take another policy loan, you pay it back, then you take another policy loan, you pay it back, and this process repeats itself over and over and over again. But the beautiful part about this, my friends, you never broke compound interest. So if this is all true, then here's what this would look like. Okay, let's say you started off with $50,000 in the account, like I said, and let's say you were willing to just continue to put $20,000 in every single year. Why would you not? You would want to build the biggest line of credit that you possibly can, especially if you know you can use it as income down the road as well. But here's the crazy part, my friends. Remember, compound interest is not exciting until you get to that inflection point. So if all you're earning is a simple, boring rate of return of 5%, but you never break your curve, you start off with 50 and you put in $20,000 a year. If we go for 50 years, okay? 50 years, that means you would have saved $1 million. Now in the beginning, it's very slow, it's very boring, right? 5% on this means you're gonna earn $3,500. Then the next year, you're gonna earn another $4,600. Then the next year, you're gonna earn $5,900. And your compound is gonna slowly start to take off, but your balance is getting a little bit bigger, and a little bit bigger. But if we go at year 25, now you put in $20,000 and you're doubling it, right? For every $20,000 you put in, you're getting 55 out. You go 40 years in, you put in $20,000, you're getting 181,000 out. You go 50 years in, you put $20,000 in and you get $250,000 out. The opportunity cost is you could have had $5 million. $5 million with a simple system of compounding your money every single year. And the opportunity cost is anything that does not turn into $5 million is the cost of not operating the system. This is why the vault plus assets is such a critical component to achieving financial freedom in 10 years or less. When I first learned about this strategy, I felt like my mind was blown. I could not believe that this was possible, but it was such a simple strategy. Now, this is why most people get infinite banking wrong. Most people want to talk about using their policy to buy cars. They want to talk about their policy to pay medical bills or to pay down credit card loans. All of those things will put you in a marginally better position, but it's only marginal. It's not the key to becoming financially free in 10 years or less. In order to understand how infinite banking was designed to work, we need to go back to the bank and ask yourself this. What does a bank lend on? They only lend on assets. They will lend on a house, they will lend on a business, they might even lend you personally via a credit card, a personal loan. And you might think you go use your credit card to buy consumer goods, but the bank is still lending on an asset. The asset just happens to be you and your future labor. So my friends, if you want to truly become a bank, you have to realize and understand that an asset is something that puts money in your pocket. You want to leverage your policy, leverage your cash value to buy an asset that will build your wealth, that will put money in your pocket. Let me walk you through a very simple case study. Now, rather than putting our money in the bank where we get low interest rates, now we have an opportunity to put our money in an infinite banking vault type policy. Our money's compounding and growing. But if you want your money to do two things at the same time, to be dual compounding, what would it look like if you leveraged your vault, leveraged your infinite banking policy to buy an asset like real estate? Okay, then you took the profits that the real estate provides and you use that to pay back your line of credit. Now, I'm going to walk you through a very simple case study, and I'm going to show you how using the vault, using an infinite banking policy will literally double I said that right, double your real estate returns. You ready for this? So let's say in this example, we buy a property again for $100,000. Now don't worry about the purchase price. I'm using $100,000 for very, very simple math. Now I'll be honest with you, inside of our community is still buying properties between, 100, maybe 175, 180,000 bucks, but let's use $100,000 for this. Now let's also say that we collect $1,000 a month in rent. And let's say we're gonna hold this property for the next 30 years. So we're gonna buy it for $100,000, we're gonna hold it for 30 years, we're gonna collect $1,000 a month in rent, and out of that $1,000 a month in rent, let's say we have $400 on average per month going out for operating expenses. So we net $600 a month in cash flow profit, okay? Does that make sense? So here's how this would work. If we buy the piece of real estate, here's what's gonna happen. We bought it for $100,000, it'll appreciate. We're just going to use a very simple rate of inflation here. So it'll appreciate to $242,000. Our total cash flow would be $216, right? $1,000 a month for 30 years minus $400 a month for 30 years in OPEX. That would give us a total profit amount of $358,000. Now, not bad, right? But let's actually look at buying the exact same house, but run it through a policy instead. What that would mean is we would have to have $100,000 of cash inside of our policy. Remember, that's our line of credit. Now, we would take that cash, we would buy the property, but in this previous example, we would still have to have $100,000 because we still bought the property in cash. Okay, now, we would buy the property, we would then take the $1,000 a month that's coming in, minus the $400 in OPEX, and the rest of the money, or a decent amount of the money, we would pay off the policy loan over 30 years. Meaning, we're gonna have to send the insurance company $536 a month to pay the policy loan off over 30 years, which ultimately means our profit that we net in cash flow is only $22,000. Now the house still compounds to the same $242,000, but now we only net $22,000 in cash. We still bought it for $100,000. Our profit on the real estate is $165,000. Now if we go back to the previous example, the profit in example number 1 was $358,000. So this would look like a losing proposition to buy real estate. How on earth are we going to double our return? Well, remember, our $100,000 never came out of our policy. It continued to compound and grow the entire time. And if that's true, that $100,000 compounded to $574,000. And if we take the $574 plus the $165, our total wealth position on this transaction, this single transaction, is $739,000. Now, my friends, if we didn't buy it, same property, we just didn't use the policy, we would have netted $358,000. With the policy, we net $739,000. Our wealth position is nearly double just by operating a better system. My friends, the infinite banking strategy is the most dynamic financial strategy that an individual can use if it's done right, if your policy is set up appropriately, and if you understand and start operating just like a bank. Now, so reason number 1 that most people do not get the maximum benefit from their infinite banking policy is they're not operating like a bank. But reason number 2 is their policy was never set up to be an infinite banking policy from the very beginning. Whether they knew it or not, they have the wrong policy for the right strategy. The wrong policy design for the strategy that they wanted to implement. So join me on video number 4, and we're gonna dive into what makes an infinite banking policy. You can use this as ammunition. You read the book, you can go talk to an insurance agent, and you can ensure that you get the absolute right policy. And I promise you, you are going to make the insurance agent that you talk to so mad with the information you're going to get on video number 4. With